Hi folks, and welcome back to Meaningful Money. Here in my kitchen again, I'm afraid the weather is still against me, although I missed some very good days when I couldn't get out and make videos, so sorry about that. Carrying on talking about what if the worst happens, the risks which face your financial planning that actually you can't do anything about whether they happen to you or not, but you can do something about the effect they have on your plans. So before we carry on talking about that, I must say thank you to my friends down here in the bottom right. That's 7 Investment Management who continue to sponsor me. So we talked about the 3 biggest risks last time. One was early death. Second was critical illness, something nasty, but which you'll probably survive, cancer, heart attack, stuff like that. And then the loss of your ability to earn an income for whatever reason. So let's deal with death first. That's the subject of today's video. Now, the impact of death on your financial plans depends on a couple of things. Firstly, is there anybody left behind if you die early who is financially dependent on you? Do you have a spouse or a partner? Do you have children? Do you have parents who may be dependent on you in some way? What will be the impact of your early death on them? Because that will help us sort of put some numbers on what it might cost to fix that impact. Maybe you've got a debt which is outstanding, doesn't get written off if you die. Somebody's got to pay it. It'll be paid from your estate, which might mean that family end up paying it for you, which would be fairly awful. So certainly if you've got debts, then you should think about insuring those against early death. Now, assuming then that there is a need for life assurance, if you've got no dependents and no debt, you probably don't need life assurance at all. But there may be other implications. But assuming there is a need, you've got 2 broad options. The first is term assurance. Now, that is insurance which has a defined period of time. So you have a start date, let's just say that's today, and then a fixed period of time, let's say that's 20 years, at which point the policy ends. And the policy simply says, if you die within the 20-year term, we will pay out. And the payout is what we call the sum assured. And you can set that to be whatever you want. So you might cover a mortgage, which has a set term. You might cover the length of time it takes for your youngest child to become independent. Or perhaps just the years until you retire. You might want a sum of money to be paid out for whatever reason in that fixed period of time. It's important to say that if you survive till the end of the term, there will be no benefit paid. Now, the alternative is whole of life assurance. Now, in a similar fashion, this has a start point, but it has no end point. It simply ends when you die. So it's guaranteed to pay out because everybody dies sometime. So that's how whole of life assurance works. It just carries on until you die. So we need to look at a little bit more detail about both of these types. So we're going to do that in forthcoming videos. Just thought I'd mention the difference between assurance and insurance, just for interest really. I've seen it mean a couple of things. One is that life assurance, or assurance of any kind, covers events that definitely will happen, hence life assurance, everybody dies sometime. And insurance covers events which might happen. Another alternative is that insurance covers losses which are not known at outset, whereas assurance covers a set amount no matter what the loss. So, you might insure your life for 100,000. If you've got a debt of 150,000 when you die, that's tough. Only 100,000 will be paid out. Anyway, bit of a sort of academic point really, but we're going to talk a little bit more about term assurance next time. So thanks for watching this one, and I'll see you next time.